Good afternoon, everyone. Welcome to the QOZ 3 fund webinar. We have, I believe, just under 300 registrants. So thank you for attending, taking time out of your busy day. If you're a partner now in any of Origin's funds, thank you for your partnership. If you're a new investor, we'll give you lots of information about us as a company, our historical returns, our competitive advantages. My name is David Scherer. I'm co-founder, co-CEO of Origin Investments. I'm joined today by Phil Schuholz. He runs our Dallas office. He's been with us for 6 years. Phil is from Cincinnati, so he's not particularly happy at 0-2. And he also owns Nick Chubb, who's out for the season. That's a double loss, my friend.
Can't win them all, Dave.
Anyway, we have a lot to cover. The format is going to be I'll present maybe the first 8 or 10 slides. I'd like to get that done in 15-20 minutes. Phil is going to go granular to the deal level. He runs all deal acquisitions for this fund and our other equity and development in Texas. So he'll be going granular on 3 or 4 deals. And then hopefully we'll have a half hour for Q&A. Many of you have sent in questions, and thank you. We're committed to answer all questions. So I'm going to try to incorporate a lot of the questions that we received prior into the presentation. If you feel like I'm not answering them or not answering them in enough depth, just let us know in the Q&A feature and we'll cover it in live Q&A. I have nothing to do this afternoon. I will stay on as long as you have questions to show that we're committed to transparency and you as partners. Okay, let's get started with the first slide, please. Because this is, we don't do this on most of our webinars at this point, but I believe the demographic here, a lot of the folks on this webinar don't know Origin. And I would just tell you, before you make any decision about a real estate deal, in particular in qualified opportunity zone investing, spend a lot of time on underwriting the manager because this is a long-term investment. You have to develop and then hold for 10 years to get the tax benefit. And so you're going to want to know that your partner has a strong foundation, both in development and operating and risk management. In our case, we've been around since 2007, so roughly 16 years. This will be our 10th fund. So we've obviously run many funds before, including 2 QOZ funds prior to this. We're very proud of our top decile ranking because it really encapsulates all of our competitive advantages. And I'll get into those in detail, but you know, the footnote really matters what you're looking at. And I know it's in small print, but we say top decile, but we've been ranked 7th out of 191 US private real estate managers and 12 out of 256 global real estate managers. And that ranking is for a consistency of performance. It's not for a particular fund, it's for years and years of consistent returns, which you see on the right, a 22% average gross IRR, 17 multifamily developments in QOZ 1 and 2, which I'll go into. And then a lot of our investors like the fact that myself and my partner, Michael, and increasingly people like Phil and our senior team members co-invest in our funds alongside of you. So 80 million to date, it's actually a bit higher than that. We need to update that with our new commitments. But nonetheless, our funds are vehicles for our own personal investment to protect and grow our wealth. And QOZ is a huge part of my personal QOZ investment strategy. I love the fact that it accumulates tax-free. Little known, but probably to some of you, but not all, you don't have to sell QOZ after 10 years. That's the minimum hold to get the zero tax treatment. You can hold it through 2046 and it continues to compound tax-free. Essentially, you're creating an IRA out of thin air. I personally don't have IRAs. I wasn't astute enough in my 20s to figure that out. And so this is serving as one of my retirement vehicles that I intend to hold for 25 years. Next slide, please. So the benefits and timeline, the first benefit, and I apologize if you know this, so I'm going to do this quickly, is tax deferral. So if you have a capital gain, and to be clear, you have to have capital gains, that's all that qualifies for QOZ tax incentives and treatment. So if you just have wealth, it wouldn't be eligible. You need to have a capital gain that you've harvested in the 180 days, and you can comply. For example, if you have a stock that you sell tomorrow, you could comply immediately by investing in this fund. Just by investing, you comply with the 180-day rule. So you could also invest in the fund in 170 days and you still comply. But the first benefit is tax deferral. And you will not need to pay your capital gain on your original investment until really 2027. It's December 31st, 2026, but that's payable in 27. So that's the first benefit. And that's a real benefit now that the risk-free rate, is 5.25%, 5.5%, meaning, you can get 5.25% risk-free on your money. I'm guessing you'd rather get that than have the government hold your money if you had to pay the capital gain now. That's the first benefit. And then the second is tax reduction. We don't have that benefit anymore in QOZ 3. That was part of the original law, but it's burned off. Initially, you got 15% reduction of your original capital gain. It burned down to 10, it burned down to 5, and now it's gone. So that really isn't a benefit right now. I will say they keep talking about extending the law in DC, and if they do, the second benefit will reappear. But I get a lot of questions about that, and those are things that we just simply can't control. We can control finding and executing high margin deals and then operating them at a high level to grow and grow your capital. I don't spend time lobbying in DC. And I will also say I'm less confident that will ever get done because they've been talking about it for 2 years and nothing ever happens. So I'm guessing it won't get done, but it could, and we'll let you know if it does. The next is tax elimination. This is a benefit that I've actually never seen in investing. I've seen strategies that defer taxes, but I don't see strategies that eliminate taxes. In QOZ investment, if you invest and hold for 10 years, there's no new capital gain on the new investment. So simply put, in this fund, our goal is to double your money or more, better. So if you invested $5 million in the fund and after 10 years, it's become 10, normally you would get taxed on that $5 million gain at cap gains. And that tax would be, roughly 20 to 23.5%. With QOZ investing, you don't pay that at all. So there's literally in this $5 million example, there's over $1 million of savings, and we'll quantify that. It's pretty significant. What I should really note though is Origin is also a very large non-QOZ development firm. We do thousands and thousands of non-QOZ market rate development throughout the country. We use the same rigor in our methodology for QOZ investment. We're not looking for any less attractive, any less profitable deals as we do in market rate. It's simply a call option. It's an extra benefit you get if you have capital gains to invest. So the way I advise our clients, because I do get, clients will call me and say, what do you think? And the easy thing is if you want any exposure to development, then it should be in QOZ if you have capital gains. I mean, that's easy. But if you want exposure to multifamily via credit, that's a different product. This is an equity product, right? So we also have credit products. So I would say, okay, well, now let's talk about that. But if you want to take development risk and you have capital gains, it should absolutely be here. It's the same risk set for a higher benefit. This timeline on the bottom is this is the life of your investment. So if you chose to partner with us in this fund, You would give us the capital in 2023, thereby complying with the 180-day rule of realizing your capital gain and then investing in this fund to comply. The deferred capital gains, because you get that benefit, but you do have to pay the capital gains on the original capital gain that was invested with us. So again, in the $5 million example, you're going to defer that initial $1 million tax, right? Cap gains at 20% on the 5 until 2027. That's a significant benefit, but you'll have to plan to pay that in 2027. Doesn't go away, it just gets deferred. All capital gains, I'm moving to 2033. All capital gains on profits are eliminated. That's the 10-year hold. So now if we create 5, 6, 7 million more of gains, you would have paid $1 million or $1.4 million of cap gains. Those are eliminated, don't exist. And then I mentioned the 2047, which I think is often overlooked. You have the ability, if you don't need the liquidity, to continue to allow this investment to compound tax-free. So perhaps the $5 million gain in 2033 becomes $15 million of gain in 2047. You're still not taxed. And that's pretty interesting. The last thing I'll say for folks that are more trained in accounting, one of the beautiful things about real estate is you have what's called depreciation. Depreciation is an accounting offset to income where you can have properties that create cash flow, but depreciation offsets so that you don't, to the IRS, have taxable income. That's true of all real estate. This fund is no different. What is different is because there is no capital gain after 10 years, there's no catch up with the depreciation. Because when you're depreciating an asset, let's say you have an asset that's $50 million and you're depreciating it every year, eventually that cap gain tax will be even higher because you're not starting at 50 million, your basis, you're starting at wherever you depreciate it from to where the value is today. But in this case, since there is no capital gain, you're getting a decade of free cash flow and depreciation, which is also pretty remarkable. Next slide, please. Here we've quantified what we think these tax benefits were worth. And I'm not going to go line by line, but in terms of where I would really focus is the effective after-tax net multiple. What that means is if you consider taxes as part of your equation, which you should, because we're all tax investors, and I would tell you that all funds that Origin invests in, creates, welcomes partners into, are focused on tax efficiency too. This is no different, but every fund we have, because our clients are taxed, so we want to do that. But in a non-QOZ investment, if you invested $1 million, after you paid your taxes in our base case analysis, you would make $950,000. Because remember that when it's 1.95, the 1 is a return of capital. So you invested $1 million, you got $1 million back, your profits are $950,000. And that's a nice investment. But with the same unit of risk, after tax, you're going to make 2.64. Again, 1 is the return. So the 1 is the million that you invested returned. But here you're making 1.64 million profits. And so you can see this is not on the margin. This is a massive benefit. And it shouldn't really surprise folks that this got put into a tax bill at a time where we had, a president who's a real estate developer. I mean, I'm not Republican or Democrat. This was a huge giveaway to real estate, and I'm not judging it. We're part of it. We're gonna invest on behalf of ourselves and our clients to take advantage of it. Next slide, please. So the fund overview, in order to comply with QOZ law, you have to develop the property by as much as you paid for it. So if we pay $10 million for a piece of land, we need to improve that land by at least 10 million. And because of that, you really wind up doing primarily ground up development. In Origin's case, we've been doing ground up development for over 12 years, over $1 billion of development. And more importantly, we've been profitable doing it. We're very proud of our track record, which is all of our realized developments have exceeded a 20% net IRR. We have a deep pipeline now, which is important because we have great infrastructure, great knowledge on the ground throughout our markets. As we sit today, we have 10,000 units across the country that we're either developing in common or preferred equity positions. And all of our acquisition teams and investment management teams, we have about 20 professionals in those areas, are very familiar and trained in every aspect of finding sites, executing sites, construction, and then in this fund, importantly, operations, lease up, driving revenue, cutting costs, et cetera, all within an envelope of risk management. And so that's also very important. So ground up development is what we need to do in this fund. We invest in the path to growth, and I'll get into detail of how we do that. We believe that we have developed machine learning and technologies that others don't have, that this fund will leverage. And we have lots of evidence that it works at a level that isn't incrementally better, but jump steps better. And then this is a build to core strategy. And so when you think about how this is going to be executed, there's a development phase, which lasts anywhere from 3 to 5 years. We have to find the property, we have to build the property, we have to lease the property. Once you do that, you refinance on the long-term debt. You want to have long-term fixed debt that matches your long-term hold. And then the rest of the hold is either going to be, it could be 5 years, it could be 15 years. It depends. You as the investor are going to have the option of getting out after 10 years or staying in longer. You know, I said earlier, I'll stay in longer. You could, or you could get out in 10 years if that's what you choose to do. But that operating phase is a core phase. And what I mean by core is you have a stabilized asset in a very low risk asset class, which is multifamily real estate, and you'll get cash flow and you'll get growth. And that's historically between cash flow and growth, it's been anywhere from 8 to 10%. Like that's what a core asset in multifamily has done over long horizons, 8, 10 years, 20 years, 30 years. If you're interested in QOZ at all, you really should start with 1, the manager, but 2, the asset class. You should take a hard look at historical data on how asset classes perform over long periods of time, because it really matters. If you invested in retail in 2010, that didn't do well as an asset class. You know, you might have had a good experience in a particular deal, but if you were in a fund, I doubt it did well. So you actually have to get the asset class right as well. I believe this is the right asset class, and the historical data would suggest, and that's why we're here, it has the highest return and the lowest standard deviation, meaning lowest risk in real estate over the last 10, 20, 30, 40 years. I mean, that's why Origin's solely a multifamily investor, is just plain and simple data. We're targeting a 10 to 12 total net IRR. Net means after all fees and promote, and a 2.25 to 2.5 net multiple. Both of those we think are highly attainable. And to answer one of the questions we got in a lot of forums, and we can open this up in the Q&A more, the market condition right now for new development is quite good. In fact, one of the better I've seen in years. And the reason is it's hard right now to get things done on the debt side. So all of your marginal players have disappeared. They're gone. But we're not a marginal player. We can find the best sites. We have deep relationships with lenders, and we're underwriting to a 6 to a 6.25 cap rate. A year ago, people were underwriting to a 5 to a 5.25 cap rate. Simply put, you're getting 100 more basis points of unlevered return and the same level of margin. A 30 margin to a 6 is better than a 30 margin to a 5. And so I really like where we are right now in the cycle. because there's just much less competition for getting deals done. And we're a firm that can still get deals done. Next slide, please. So here's where Origin invests. The way that we're structured, we have about 60 professionals at Origin. We're headquartered in Chicago. We have lots of our analysis in Chicago, all of our accounting, all of our legal, most of our investor relations. But all of our production offices where our investment professionals reside are in the markets we invest. So Charlotte is the far right, obviously Nashville is next to it. And then as you go south, that's where Phil is today. Actually, he's in Austin, but our Dallas office is where he home bases. And then Denver is our Western hub. And so we believe at Origin that it's not really defensible to all be in Chicago and then fly to markets. We don't think that's different. We think it's worse. I want Phil to live in Dallas, integrate into the society in Dallas, meet people in Dallas, understand Dallas by living and consuming Dallas things. Same as Denver, same as Nashville, same as Charlotte. And that's been one of the big reasons we've outperformed. This is something we did 10 years ago. It's not a new thing. And then the second, and I mentioned this, is Origin Multilytics. And I actually think it's time again for another webinar just on Multilytics because they take an hour. And there's just a lot to cover here, but Multilytics is best in my opinion, the best in the world machine learning that is focused solely on rent growth in our markets. It takes in 3 billion pieces of data a month. And we've been working on this for over 3.5, almost 4 years, because everything that we saw in the market didn't satisfy our needs. There are firms that you can license technology from. The problem with those technologies is, number one, they're not predictive, meaning they're actually not accurate. So that's a problem. They're also not accountable. They constantly change their predictions and they're capricious about how they're coming up with rent growth projections. It can be 3 one month and 0 the next, same market. And then the third is they're not granular. They go down to the zip code level. That's not granular enough in real estate. What you want to go down to is the building level. You invest in a building, not a zip code. And for those that are in larger zip codes or even diverse zip codes, you know that there's very, very different areas of the zip code, and you might want to be on this street, but not that street. So it's very intuitive, the problems that we encountered when you think about it, but we believe that what we've built, and it leverages cutting edge technology from University of Chicago. We were very fortunate to get some of our data scientists from a program that was teaching analytics that were niche, that weren't mainstream, and we've applied it across the model. And there's very many reasons it's great. I don't want to go in too depth because a lot of it is proprietary, and I want to make sure we'll have a full webinar on it. But I will tell you, it's been unbelievably predictive in 21, 22, 23. For example, in 21. Our machine learning predicted really across the country 15 to 20% rent growth for the year. To give you an idea, rent growth historically is 3%. It was predicting 700% more rent growth than historical, unheard of. All these other licensed models were predicting 1%, 2%. It wound up being 25%, in certain markets 30%. In 22, we predicted strong rent growth in the first half of the year and then flattening. That's exactly what happened. In 23, it predicted negative growth throughout the US. To give you an idea how rare that is, and that's why I love multifamily as an asset class, that's happened 4 times in 100 years. Spanish flu, Great Depression, hyperinflation in the 70s, Great Recession of 09. And in all those instances, it happens for 1 year and turns around because it's such a in-demand asset class. It can't stay down long. We predicted negative rent growth this year. Nobody did that. But now, if you went to some of these other competitors and said, hey, what's your rent growth in Austin? They are mirroring ours. Why? Well, they started out at 7%, then they lowered to 3%, and then last month they lowered to -1.5%. And that's what I mean, that they're not accountable. You can't trust any data that comes out. With ours, we make a prediction January 1st, we hold it. And then we make another prediction the next year. It's been unbelievably accurate. So at this point, every decision we make at Origin, including the cities we invest in, the submarkets we invest in, the addresses we invest in, it doesn't make the decision for us, but it's a huge part of the decision tree. And Phil, when you go in depth on some of these deals, you should talk about how it's integrated into our investment memos and how you as a deal officer are leveraging multilytics. I think there'd be some real value there. Next slide. Again, the timeline of investment in a 10-year investment, I mentioned that you have a development and lease up period. I mentioned it's generally 3 to 5 years. That's captured in the blue and light blue. And then the hold extends to 10, and that's when you'll have the option to get out or stay in. That's up to you. We estimate that anywhere from 0 to 25% of capital will be returned by the end of 2026, but there's a lot of assumptions in that we can't control. I don't know where interest rates are for the next 3 years. If they go down, there'll be more cash flow available than if they went up, for example. So when we advise clients, I'm most comfortable saying you should plan for your own cash needs for that original capital gain at the end of 2026. I don't want to, be on the record saying we'll provide that capital. We'll certainly make best efforts, but there are variables that are out of our control at this point, so we don't want to do that. Next slide, please. So this is a snapshot of QOZ 1 and 2 developments. And both of those funds, and this is actually pretty important, they were both about 300 million of equity. One of the red flags, Origin has become very successful at what we do, and it's based on long relationships and candidly performance over long periods of time, but we don't get bigger and bigger in our fund size. We're very good at investing about 300 million. It's interesting and should be to you that Fund 1 and Fund 2 were both the same size, and Fund 3 is going to be about the same size, because that's what we feel we can invest well into high margin deals. And believe me, there still are high margin deals. That's another question we get a lot. There's a lot of deals, folks, that we looked at 2-3 years ago that we're still looking at. There's a lot of deals that you think are gone, they're not gone, they come back. And so that's absolutely not the case. There's still good deals to be done. But this gives you a flavor of invested equity to this point is 308 million. Required equity for these two funds is 510 million. That just means we haven't, when you invest into development, it's scaled over time and how much development has happened. We're scouring what the GCs are doing, and then along with the banks releasing money, so that will become 510 over time. And then of course the last is just the total value of what's being developed for those funds. Now, in addition to these deals, we have an entire development fund called Origin Growth Fund IV that's market rate development, and that's going to have another 150 to 200 million of equity deployed. In addition to that, we have Income Plus that also does development. It has a development sleeve. That's a $400 million fund that does development. And then some of our prior funds, like Fund 2 and Fund 3, also have development. So when you're talking about QOZ 1 and 2, Income Plus, Growth Fund 4, this winds up being our 5th development fund with exposure. So that's how much you're getting a decade and across 5 funds of exposure to development. Phil, you can probably speak to this too. There are so many instances where deals that we do on the market rate side result in relationships that bring a QOZ deal, or vice versa. right? Because we're just very active, period, in the market, which leads to better information, but also obviously better deal flow, and we leverage that. Lastly, if anybody here is an income plus, we're one of the largest providers of preferred equity. Well, why does that matter? Because we're always in the same rooms with developers who need preferred equity, but maybe we wind up doing common equity, or maybe it's in reverse. The point is, we never, and this is really my job first and foremost, is I run the teams that are finding and executing these deals. I can't tell you the last time I saw a deal and sent it to an officer and they said, oh, I haven't seen it. It's just like, I'm almost reluctant to do it anymore because it just doesn't happen, right? I'm seeing in Chicago, because I'm in Chicago, when a deal gets to me, it's already been through the mill, and they saw it 3 months ago, 6 months ago, past, whatever. I mean, it just doesn't happen. Next slide, please. I think this is you, Phil.
Yes, this is me, Dave. But glad you brought up the about being in the market and growth fund deals, potentially becoming OZ deals. That's actually why I'm in Austin, as a partner of ours. And a growth fund deal actually has a pretty phenomenal QOZ site that is being worked on, one of the last large tracts of land and all those, Austin, for a QOZ that's about 30 to 40 acres mixed use. But as Dave alluded to earlier, I'll get into the pipeline here, but deals that we see in the past necessarily don't mean they're gone. As Dave mentioned, a lot of stuff, especially here, like in Austin, where you hear of the stories about just how long it takes to go through the planning and zoning. It's true. The average time to get through zoning here in Austin and get your permit and the site development plan used to take about 6 months. That's all the way up to like 12 months now, and that's on a good day. So deals that we were looking at a year ago, year and a half ago, that people thought were coming through the pipeline, they just take time, unfortunately. And that's the benefit of always being in the market, like Dave said, and seeing all these deals. Is we're seeing all of it, how it evolves, whether that's other deals coming out of the ground in the area, where hard costs are going, what other people are doing. So we do have a competitive advantage when it comes to development in general, just given our preferred equity placement and just deal volume in general. On the market rate side really helps us triangulate a lot faster than other groups. I'll dig into the pipeline here. A lot of this is high level, but I think what really I want to articulate first is just, again, volume. We see a lot of deals, and what you see on this pipeline sheet right now has made the pipeline sheet, but it's gone through an extensive funnel, right? We probably see a deal or two a week in the QOZ, but for it to actually make the pipeline sheet means that we've had to analyze it, send it to Chicago to our analysts and associates who put models together to run, cursory desktop. And to make it on this pipeline sheet, we've probably seen, a couple hundred to dwindle it down here to what you're seeing today. But overall, we're still seeing a tremendous amount of deal flow in the OZ. It just takes a little longer. A lot of stuff we're looking for today. We're using our multi-lytics platform that really helps me as a officer understand where kind of the outsized rent growth may be. QOZ is a little more nuanced, just given you have to invest in specific tracks that were designated as QOZ. So your opportunity set's definitely a little more limited than a traditional market rate. So it actually makes it pretty simple for deal officers, given there's only so many areas within a market that's even QOZ investable. We can quickly identify the areas we want to be and kind of like, front run and know who's going after those pieces of land to get in the pipeline early, just knowing that developer is going to need 9 to 12 months lead time to get even the plans and permits to even be able to move dirt. So as on this sheet, we have about 2,700-ish, call it, units, total asset cost, around 725 million bucks. This would equate to about 300 million of equity, as Dave alluded to earlier. Equity is definitely a little higher on deals, just given the leverage, capital markets constraints. The cost of capital has definitely gone up on the debt side and banks coming down in leverage, but nonetheless, we are still getting a lot of banks given our relationships, and then developers and sponsors who we choose and to partner with definitely helps. I'm gonna jump into the next slide here, just on a specific deal, or two deals actually that are pretty far along. If you want to flip, the first one here is this Atlanta infill deal. What's really interesting about this deal really is the economic incentives from the city. It's infill as well, which is also kind of interesting. When the QOZ was drawn, as many of you might know, it was done back in the 2010 census. Well, a lot has changed since 2010 in a lot of these cities, especially like in a city like Austin, where a lot of these, infill QOZs aren't really kind of like up and coming neighborhoods. They're pretty much gentrified already. And that's what Origin's looking. We're looking for those neighborhoods and QOZs that's kind of past their maturity already and in the extreme growth phase of the gentrification, which has already occurred in a lot of these because of when the census was created for these opportunities. I'd say in general, though, not just this Atlanta deal, but I think one thing we've seen, and Dave can attest to this, but a lot of stuff we're looking for in development nowadays, given where construction costs have gone, typically you have to have a really good story to make something meet our cost of capital, which is about a 30% margin, which is a six and a quarter-ish return on cost using our numbers. That being said, usually the only way to do that is you have to find a unique story, whether it's the land was bought by the developer about 3 years ago and maybe they've been sitting on it for a while, so their cost basis is really low, or you find some unique incentive with a public-private partnership similar to this Atlanta deal and some of the stuff we're doing in Texas, which you may have seen on other webinars with tax abatements on property taxes to help juice that yield on cost to essentially make the margins work. Most deals that come through the pipeline these days, to be completely honest with everyone, are probably 5.25, 5.5. And that's just a function, again, everyone knows where hard costs are in every market. Land's pretty ubiquitous. It's about 20 grand a door here in Texas, 20, 25, depending on where you're at. But all the variables are known. So again, it's just finding the edge to tell the story to really drive outperformance. And then using multi-lytics as well. We're looking for deals that have tremendous rent growth, typically over 3%, which we know over 10 years, as Dave alluded to earlier, 3% is the 10-year norm. But if you can deliver 3.5 over 10, that's huge outperformance over 10 years when you're compounding at a 3.5 versus 3% rate. So using all these different tools we have is really where we're trying to find the alpha and the investments we're looking for. Next slide, please. Here's another really cool opportunity that's pretty far along in Greenville, South Carolina. We really like Greenville. Multilytics really likes Greenville, up and coming. The units per capita is really small, which is good. And we talk about units per capita is the same lingo as you would say supply and demand. We believe the population growth in Greenville just being a little more affordable is definitely driving, and then units under construction isn't near as crazy as a lot of other markets where you probably see a lot of headlines that, like Austin, for example, where I'm at today, 15% of all inventory of supply is being delivered in the next 12 to 18 months. That's a scary number. Historical norms for most cities are about anywhere from 3 to 5% on average. So these are definitely eye-popping numbers, but that's really what Multilytics is also helping us do, is find these tertiary markets. And I want to say tertiary, but ones that maybe institutions are starting to go into like a Greenville or Tucson that are, very close to major cities that people are moving to just because of quality of life, affordability, you name it. So this is a great example of one that we found in downtown, which again is in a QOZ that we believe shouldn't be in a QOZ, but was done in the 2010 census. So that's helping us here. And just finding these unique outliers with strong sponsors and the demographics that we believe can push farther rent growth when we deliver. So next slide, please. So I highlighted two specific deals that have some edge, but I think it's always good to go back and maybe explain a deal that we've been watching for a while and working through and present it at investment committee, but actually have passed on. So this was a deal in Charleston. We've been, man, I think, Dave, about over a year now we've been chasing this deal, but this deal's come to investment committee quite a bit over the time, but it's also changed a lot. And I'd say what's really unique about this opportunity, and this is what happens in development, right? Because it's such long lead times. You have a lot of variables that change over the course of a year. In this instance, the biggest challenge that led us to actually end up passing on this opportunity recently really came down to two things. Really, the hard costs that the developer is getting from the GC, unfortunately hasn't moved down. And that goes for all of our markets. Hard costs to date, everyone's anticipating costs to come down a little just because, the economy feels like it's getting a little slower. People are starting to realize maybe they don't have as deep as a bench of deals coming out of the ground as subcontractors. But in reality, everyone's cost has gone up and that cost has stayed pretty elevated. And to date, unfortunately, we have not seen a reduction yet in hard costs. That doesn't mean it can't come, but that's something we're not, anticipating. We're going to assume that costs are pretty much going to stay flat. But that was one component. We just couldn't get the cost down to the basis, which really ultimately impacted where other deals were trading and the exit. So that was kind of essentially the margin was just a little squeezed. And then really on the other side, what really hurt us on this deal, given we looked at it about a year ago, the debt and capital markets, we were underwriting this deal at 60% debt when SOFR plus 300 was down at SOFR, 2.5%, 3%. Well, since that SOFR curve's moved so much to, 5%, 5.25%, our interest carry on this deal is another $2.5, $3 million. Well, at the end of the day, that's all capitalized in a budget, and something that to be cognizant about. And we are extremely stress testing that all the time on a lot of the deals we present at committee is the what if scenarios if delays occur because transformers might not come, or just delays in general because the local municipality is slow at issuing TCO. That drives interest carry, and that's something we're always looking at and shocking the curve to make sure we're carrying the appropriate amount in our budget, and not stuck with a $2 million shortfall in the future of potential interest carry because of where SOFR has gone or where it hasn't gone. So that's just a prime example here specifically of some of the elements of why a deal can look good, but then, as time goes on, it can also be a deal that Origin kind of backtracks on and ultimately passes on. But that doesn't mean, again, that in the future, something could change and this deal might come back in 6 months. Maybe costs do come down and could, very well end up back in the pipeline. Next slide, please. Dave, I think this one is you to wrap it up on the summary here.
Thank you, Phil. Yes, and we got a couple questions on this, so that's good. Direct question, I'm moving to live Q&A. The minimum investment is $50,000. And yes, that was the same minimum for QOZ 1 and 2. I think that was the question. I'm just going to, I want to make sure I'm addressing the person who asked. Hold on. Greta, the minimum required. Thank you for your question, Greta. I appreciate it. Yeah, and it's 50,000, same as QOZ 1 and 2. Most of our investments, I would say the median or the average, I'll give you a range, probably 300,000 to 500,000, but we have plenty of clients we really value that, 50,000 is a lot of money and we understand that. Okay, the annual management fee is 1.25% of net asset value. We don't have a committed fee. Most managers do, meaning when you give them your money, they start charging you immediately. If we don't have assets, there's no asset value, so we're not charging. We don't charge you at all. So that's a huge benefit, by the way, to you, the investor. You're not paying for deals until we get the deals done, and then you start paying. We do have an acquisition fee, which is 0.5%. And then the performance fee or promote is 15% after a 7% preferred return. There is a 50-50 catch up. And so if you think about it, what a catch up means, many of you know what that means, but what it means is if the investment gets 7%, that's all it gets, then there's no promote at all. Like you, the investor, capital gets all the money because we need to give you 7% annually for the life of the fund in order to start participating in profits. The 50-50 catch-up simply says, look, if we make 15%, at the end of the day, you've met your 7% return. We should be getting 15% and you get 85%. And the catch-up allows for that. That's how that math works. It's very standard in private equity. I'll also say the 15% performance fee is below market. It's certainly below market for the level of service and management acumen and competitive advantages that we have. I think market's 20%, but I would leave that up to you to do research on, and I would welcome that conversation. I think we're very fairly priced, and more importantly, we're a top decile manager. I mean, what you really need to focus on is the value. I think the fees are on the lower end as well, but I would focus more on the value. In terms of one-time upfront setup fee, this is just the formation of the company fee. Again, totally standard. Every fund has it. We're incredibly low in this area because we sell direct to clients. We're not paying a broker dealer or a large investment house to find you. We have dedicated people in marketing and investor relations who do this. So it does scale down with the size of the client. So there you see the fee breaks. This is a one-time fee only. But if you're 50,000 to 250, you see it's 2%, and it goes all the way to zero if you're 5 million or above. And so this is the fee structure of the fund. I think it's very competitive. And I welcome all of your feedback on it. I just noticed, and then you see on the right, just general, our counsel is better priced. We also have 2 in-house attorneys and a paralegal, but we outsource the fund level legal to better price. Fund administrators, SS&C, we've used them many times. Our reporting is Juniper Square. We leverage their technology, and then on the client service side, you can expect quarterly reports and quarterly webinars because we do that for all of our funds. And I guess the last thing I'll say is every client at Origin, and we have thousands of clients. We also have, if you're an investment advisor, we have over 85 investment advisory firms that have approved our funds, and in some cases, mini funds, and partner with us in that way. Every investment advisor and every client has a dedicated investor relations contact. And hold us to this. Our standard is to get back to you in person that day. So if you have a question, you're going to be responded to by email or phone. Some people don't want phone calls, but if they do, by phone or by email that day. So we're very committed to all of these things because they're real pain points. And this is an important investment, and we want you to feel supported throughout. I'm going to move to Q&A. If I didn't answer the terms, just pile onto the Q&A, which is fine. There's always one person in the chat, and I love that. So the chat is one-time upfront setup. Is that per investor or per RIA? I'm assuming, Brian, you're an RIA. We have a dedicated RIA group. And so I do know that with RIAs, we pool all those clients under one RIA. So if you have 50 clients that are all investing into QOZ, they're all aggregated and they all receive the best pricing per the sum of all the clients. So in aggregate, if they were over 5 million, they all pay zero. And so that's a benefit that RIAs have. I hope that answers your question. If it didn't, and I want to make sure that you get this, Brian, David at Origin Investments, really everybody, David at origininvestments.com, email me and I'll respond, or I'll send it to one of our team members who can respond. Maybe it's our general counsel or someone else who can handle that better. Now the chat has a lot of activity, which is fine. I can do both. I don't, it says Lubo, but I don't know if that's your full name, so I apologize if I'm not seeing the whole name. It says, can I invest if I'm an EU resident? Anyone can invest in a QOZ fund. Right, I know EU means European Union. Anyone can invest in the fund. If you're not a US citizen, you won't get the US tax benefits. So we don't have a lot of investors in the fund that aren't US citizens for that reason. We do have, well, that fund's actually closed, but we used to have a market rate development fund, and we certainly have exposure development in our income plus fund. But you can invest is a short answer, but unfortunately you won't get the tax benefits unless you're a US citizen or a dual citizen. I hope that answered your question. Mike in the chat asked how much is left in QOZ 3 for investors. I think that means, the fund size is roughly 300 million, how much has been raised. We just launched the fund. So we don't launch a fund until we're completely done investing in the last fund. That's another way. We're probably a little bit different. I mean, we're a fiduciary to fund two. Our focus is in fund two until we're done sourcing fund two. So that ended in Q2. So we just launched this fund. I think we're about 10 to 15% to the goal. So we're completely open, and we will be raising for this fund certainly until the end of the year and possibly longer than that. I hope that answers that question. I'm going to move to the Q&A. Okay, so Phil, this is a great question for you. And I saw it before. It's just a great question. Anonymous. Even if locations are in path of growth, aren't they inferior to non-QOZ locations, generally speaking? So how can we get the same returns in QOZ as you would in a market rate fund? I understand there's huge benefits to investing in QOZ, but I don't understand how it could be just as profitable. So I think that's a great question, and please take a crack at it.
Yeah, so if I distill this down, it's asking what's the difference kind of between the investments in terms of return profile, Dave, between a non-QOZ and a QOZ deal?
Yeah, why would a QOZ deal do just as well as a market rate deal when you have maps and generally they're supposed to be in gentrifying areas, right? So
Yeah.
why would it
So
do?
I think let's start, I guess, with the first unpacking this. So at Origin, in terms of just deals, we don't view a QOZ deal any differently than a market rate deal. So I think starting with that, just as a high level, when we say we're solving for a 30% margin, that's regardless of it's, we don't say because it's QOZ and there's no taxes at the end of the rainbow personally, that's a different deal than a market rate deal. So I think let's just start with that we view all deals in the same lens when we go to credit committee. But in terms of just deals in general, I think a non-OZ versus an OZ deal, it just depends again what the area and location is and what your basis and cost is of a deal. You could also make the argument the gentrifying, if it truly is gentrifying, you come in at the right time. Timing's everything typically. So if you get into a market that's gentrifying early before it's stabilized, that means you're probably in at a better land basis because people haven't fully understood the value that's being, coming that way, which all gets lumped into that yield on cost. So in reality, if you're ahead of the curve on the QOZ of a gentrifying area or non-QOZ, you're getting that benefit in your land basis typically, and then the gentrification would be outperformance and rent growth. So that would be something that we would see not only in multi-analytics, hopefully, when we're doing our analysis of using our AI machine learning for gentrifying areas, but as a deal officer, knowing, for example, if something's coming in down the street that no one else knows about in 2 years, that can facilitate what the machine should be seeing and what I personally believe in my gut about where people want to be, what retailer walkability, desirability. So it all gets put in the soup, but I think that's really the edge, is getting at the timing is everything.
Yeah, I'll add maybe a story. here. At the end of the day, we don't develop a area or a submarket, it's a building. So for example, in QZ 1 and 2, we found in Colorado Springs, a rapidly growing inner city, Colorado Springs, with primarily 1980s multifamily housing stock. And it was just undersupplied, they didn't have enough. And there was massive population movement from Denver and just all over the country to Colorado Springs. So we identified an area, and Multilytics is helping with this, that is looking at outsized rent growth. This is in 2021. But then in addition to that, the entire downtown of Colorado Springs is in a QOZ. So we're getting this benefit. But then in addition to that, Colorado Springs is offering 70 to 75% 10-year tax abatements, which is our largest expense, meaning we're not going to pay 70, 75% of taxes for 10 years. So like, we talk in these broad ways, but at the end of the day, you're looking for specific deals with high margin, and there's reasons. And so the same dialectic that applies to a market rate deal applies to a QOZ deal. We need to believe that there's a 30 to 40% margin that we can create and execute. And then on top of that, we're using, and Phil spoke to this, the atemporal Multilytics model is regressing out time, making it a long-term growth model into our criteria, because in QOZ, we need to have growth for 5 years, 10 years, 15 years. We need to see that, right? So if you create a lot of margin in a city that's not growing, eventually you'll underperform a deal with less margin and more growth. And so we're trying to do both, right? And we're leveraging technology, but also our feel in both market rate and QOZ deals. The last thing I'll say is, remember, the QOZ mapping was drawn in the 2010 census. Why? Because it's a 2017 law. It wasn't redrawn in the 2020 census. So when you're thinking about the cities we're in, Charlotte, Austin, Denver, Raleigh, Nashville, how much of these cities changed in the last 13 years? Massively, right? So what happens? Well, we wind up with a deal in Nashville that, in my opinion, is the best land in the Southeast. But guess what? It's also in a QOZ. Why? Because in 2010, it wasn't a good area. But man, is it different now. We're right across the street from the Amazon HQ that's being built in Nashville, but it's also a QOZ. Is that the intent of the law? No. Is it my job to maximize returns for my investors? Yes. Like, I'm not apologetic about it. We're complying with the law, but it so happens that that particular site probably shouldn't be in a QOZ. So I hope that answers that question. Another anonymous is, once you receive our funds, do they begin earning interest in the money market, and do they accrue the preferred return? And the answer is yes to both. All of our funds, not just for QOZ, but for any fund that isn't invested, that's receiving 5.35% in FDIC guaranteed accounts. The banks that we use are able to leverage FDIC protection across all accounts. So we have hundreds of millions of dollars that are FDIC guaranteed, and this will be too. And in terms of the accrued return, yes, you do accrue that from day one, and that's the advantage of investing earlier than waiting. I think I answered that. We answered that. Can you, Phil, here's one for you. Can you talk about occupancy rates you've seen in Fund 1 and 2 for stabilized properties, and if you're seeing the demand you anticipated? And, I think we're still in development in a lot of those properties, but, certainly the Rosie, Navigation, and our Phoenix asset phase 1 could be a proxy for phase 2.
Yeah, I can speak high level about this because this is kind of something that we saw coming a little earlier, but it really goes back to the occupancy question, and I'll just talk more market level. Occupancy's definitely dipped over the last year. This is just fundamentally, again, supply issues in a lot of our markets, delivering units, a greater than 5% of the inventory. in the market. But I want to also caveat that and say it's very market specific and sub-market specific. There are pockets of every market that aren't getting hurt on occupancy, given it's harder to, high barrier to entry to build. So those have been more resilient, and we haven't seen too much occupancy dip on those. But that is something we are monitoring closely, is occupancy, and again, rents. This is something we forecasted going down because of occupancy. People are trying to buy it back, which means they got lower rents to usually buy their occupancy back. So we're seeing that a lot in the markets, and what's driving some of that negative rent growth that we alluded to earlier. But overall, I think what we all need to remember, as Dave said, over 10 years, we see rents really picking back up in 2025. Because again, there's no deals really coming out of the ground right now unless you have a really good banking relationship, your tier one group, tier one sponsors. That's who's getting deals done right now. And those deals will definitely be at a huge advantage, in our opinion, when they do deliver in 2026, when there's no other supply in the market, and all that supply coming online right now is chewed through, and occupancy kind of stabilizes at that typical 93 to 95% range, depending on the submarket and market specifically.
Thanks, Phil. I'm going to answer one more, and if I don't answer your question, please email me, david@origininvestments.com, and we'll continue the conversation offline. I want to be respectful of everybody's time. Let me see. Do we expect QOZ 3 to be our last QOZ? This is anonymous. I would say yes, unless the program is extended. It's possible that we could do a QOZ 4, but again, we're fiduciaries to this fund, and we're going to take our time to do this 100% the correct way. And it could be that this winds up being the last one. Not sure. Phil mentioned this earlier, but development is an inexact science. And, I think investors, the margins are quite large, but you're playing a game that requires patience and skill and risk management. And you can do very well in it, but I don't think investors oftentimes understand. We have to talk in terms of ranges. The activities are always there, but a lot of the times there's people involved that you can't control. If we're in a municipality that, for example, Austin, Phil mentioned it, that has a lot of activity, and their inspectors and city officials, they're not on your timeline. They don't care. They don't care that you're in a fund. They don't care you have investors. They have their own agenda, and you're just part of it, right? I can't control that. So anyway, I would say Fund 3 is the last one, unless they extend, with a small chance that we could do a small fund if we invested QZ 3 quickly. Chris had a question about insurance in Florida. Totally agree, Chris. Insurance has gone up significantly in Florida, but really nationally. It's not just Florida. It started there, but Las Vegas insurance has doubled. Figure that out. They're not near hurricanes. There's no fires in Las Vegas. Like, why? The why is insurance companies are losing money, and they're losing money because weather has gotten worse globally, and also the cost to rebuild has gone up so much, and they didn't model that. They did not model replacement costs being 30% higher, not 3% higher. So they're looking to recoup it everywhere. One of the reasons, Chris, I like this particular fund is when we're looking at underwriting to our standards, which are very rigorous, a 6 to a 6.25 cap, that's with these higher insurance costs that have now doubled. I don't think they can continue to go up that pace. I actually think that insurance was mispriced, and now it's been repriced in a violent way. And I think that there's actually a real probability it comes down from here, not up. Could be wrong, and we don't model that. We're modeling a growth rate of insurance, but I feel pretty good about the distribution of insurance relative to the new risk set. I think probably at premiums today, insurance companies have overreacted the other way. And that's obviously exacerbated by a lot of them have left certain markets. And so you'll see probably states start to step in too. The state of Florida needs to have an insurance market that works. The other thing I would say is, if you're thinking about the negatives of Florida, and they're real, I would add to the insurance conversation, storms are real. I mean, global warming is real. The oceans are warmer, and that's fuel for these storms. So, but on the flip side, it's a zero tax state, and increasingly wealthy people are just moving there in droves, and that's what you see fueling growth. You know, growth in home prices, growth in quality of living, because when wealthy people move to Florida, they want to recreate what they had in New York City. And so that means the arts, that means restaurants, that means infrastructure, that means sporting teams. I mean, universities, schools, that's what's happening in Florida. And then it becomes this massive network effect where now you move to Florida because certain areas start to feel like what you knew in the Northeast, but there's no taxes still. So, you know, there's always debates, and you can go both ways with it. But I believe in Florida growth mainly based on the strength of their balance sheet and their low taxes, largely funded by tourism. You know, that's the big X factor they get. Sales tax and tourism pays for so much. I hope that answered your question. If you don't feel I did, please email me. Sanjeev has a question about fees. He wants to do a tangible example of fees. Sanjeev, that's a great question, and I'm not trying to not answer it. I would like to put you in touch with one of our investor relations professionals, and they can take you through. So email me at David@Origin Investments, and we'll go into detail on that. I think that's a great point, and we're happy to do it. If I didn't answer your question, I'm sorry. It's 3:08. There's 4 or 5 left. Email me. Phil, thank you for your time. We can only go up from here with the Bengals, right? Can't get worse. You're at 0.
We're at 0, can only go up.
Well, thanks for your time, and I appreciate everyone's time today. Please email if you have questions, and if you're a partner, thank you for being a partner at Origin. Have a good day.